Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Morning Call. We're coming to you as always live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay, with me is Nigel D'Souza, and today we have Mangalam in the house to wrap up what's actually been a great week for the markets.
Well, indeed, but besides it being a Friday, besides it being a start of a new series, it's a very special day here in the studio because our very dear Surabhi's birthday. So, Surabhi, happy birthday. Wishing you a good day. Fantastic year ahead, and it's been great working with you. You've been, real support both on and off field. So, wishing you all the best and a crackers coming up this year.
Thank you so much, Nigel. All heart when Nigel's there, whether it's in the studio or in the newsroom or outside, it's all heart. Thank you so much.
Wish you a very, very happy birthday.
Thank you,
what's interesting is that today is also a very auspicious day. It is the Juggernaut Rath Yatra,
I didn't know today
which
is the Rath Yatra.
actually is a very auspicious day in large parts of the country. And I'll give you an incredible piece of trivia. If you looked at the Nifty over the last 4 months, the way it moved, the one English word that comes to your mind is Juggernaut. Why is that?
Yes.
Because through Operation Sindoor, through Iran-Israel, through Trump trade tariffs, everything, we've managed to go ahead and gain.
Oh, yes.
And the English word Juggernaut actually is derived from Jagannath, which basically means a force to reckon with. The last 4 months have been fraught with a lot of uncertainty globally and locally. Let's hope this auspicious time that there is, the next 4 months are incredible, not just for you, but for the entire country and the world.
Absolutely. I didn't know that. That's great trivia. I didn't know Juggernaut was derived from Juggernaut, Lord Juggernaut. Wow, that's fantastic trivia. Thank you so much, guys. And actually, it's a good feeling. It's a good feeling to have the market also be where it is, because we've come a long way. It's been a hard couple of months, but the bulls have managed to prevail. And that's the story this Friday morning as well, as we look at the global cues. So what do we have? We have the fact that there is obviously the geopolitical risk premium that's completely gone. So that issue seems to be at least absolutely in the rear window, almost over and done from a market perspective, at least for the time being. And it's not just here in India, but global markets, US markets are almost at the doorsteps of blue sky territory. You had the 3 indices rally last night, almost 1% each, and all of them are just a smidge away, a couple of points away from hitting those fresh all-time highs. The S&P 500 is, just not even 0.5%, less than that, away from the all-time highs. So one, you have the geopolitical risk fading into the background, and the second big booster shot has come in yesterday in the form of the possibility of this July 9 tariff deadline being pushed back. Now, where is this coming from? We don't have a tweet, we don't have a post from the US president, but we do have comments coming in from the White House press secretary. And I actually want to quote exactly what she said, because this is extremely important. This is Caroline Levitt, and she was speaking to reporters at the White House yesterday, and she says the July 9 deadline for restarting tariffs on nations are not critical. So she's saying these exact dates are not critical. Perhaps it could be extended, but that's a decision for the president to make, end of quote. So that's the statement that's come in. It's only adding to the risk appetite. Equities are higher. On the bonds and the money market side, the dollar side, there's something very interesting going on over there. That's the quote. That's what she said. And obviously, markets are taking it with both hands. And markets had started pricing this in perhaps already. The fact that July 9 may not be the end of the world kind of a day. These are negotiations. Maybe they go on for a while longer, so the market can continue doing its thing. Now, let's quickly talk about the yields and the dollar. On the yields, we had a move down yesterday because the bond market is now dealing with the prospects of what happens, Fed continuity. Is Jerome Powell going to continue his term or not? He's supposed to last till May next year, but let's see. So the 10-year yield actually fell 5 basis points. There was some element of risk in the bond market. The dollar has been falling consistently. The dollar index is at over 3-year lows. The dollar is at a 3.5-year low versus the euro. In fact, yesterday, during the intraday US trading action, the dollar index had slipped below 97. So let's watch for this. Today is an important data point from the US in the form of inflation, and this is the Fed's preferred gauge, the PCE index. That will come out today. The expectation is that it should be almost flat month on month and up 2.3% year on year. So this is important from the macro point of view. For us, it's been a fantastic week. The Nifty has managed to punch through that trading range after a long, long time. Yesterday, we had more follow-through come in. And look at the kind of buying from FPIs. Explains why large caps were on fire yesterday. Yes, you can argue it was skewed by blocks like PB Fintech, etc. But even X of that, it's a huge number. You cannot sort of write this off or, wish it away. So solid news over there. I'll just end with the distance from the peak for the Nifty. Just 2.8% from the all-time high. That's the Nifty. And the mid-cap index is just about 2.5% away, 2.7% away from the all-time highs as well. So it's a feel-good Friday for sure.
Well, indeed.
It is a feel-good Friday. So let's listen in to what US President Donald Trump said. He could extend the upcoming deadlines for reimposing high tariffs on imports from other countries. Listen into the White House press secretary's comment that Surbi alluded to. We hear that out and set up the market once again.
The deadline is not critical. The president can simply provide these countries with a deal if they refuse to make us one by the deadline. And that means the president can pick a reciprocal tariff rate that he believes is advantageous for the United States and for the American worker. And he will continue to do that.
All right, tariff or no tariff, the uncertainty continues. But what is certain is that the juggernaut of the market continues to move on. We look at the last 4 series. The Nifty is actually, added almost 3,000 points in just the last 4 series. March 2025, we had about 1,000 points. Thereafter, April, we followed up with around 655 points, 600 points in May. And June, what a beautiful series it's been, 700 points through all of the uncertainty that we've seen around trade and geopolitical uncertainty that we have seen. The last time Nifty gained more than 4 series was way back in May 2017. Every time we've had 4 series rallies in the last 6-7 years, we've actually seen a puncher in the series after that. The last time it was June to September. Thereafter, we saw some selling come by towards late September, start of October. Nifty hasn't gained for more than 4 series since May 2017. Can this break this time around? Well, July series, Nigel will talk about that quantitatively in detail shortly. But in the last 10 years, July has been negative just twice. So one of the streaks breaks this time. Nifty either makes 5 straight series or July turns negative. But it's a very good trade setup. Wall Street has seen a good close. Asian markets have opened fairly well. GIFT Nifty has indicated a start of almost 100 points in the green. Nifty broke above important levels yesterday as well. So now all you do is back calculate the distance to the top. The Nifty Bank hit a fresh record high yesterday. Absolutely, phenomenal move that we've seen. The Nifty is just about 2.8% away. So now the onus is on Nifty IT and Reliance to take the Nifty higher because both those indices are still 7 and 15% away from their 52-week high. What are the key triggers that we're tracking for July series? Don't lose sight. We're very close to the result season. So quarterly updates and Q1 result season comes by. Geopolitical developments. While the street is abating that, we're still not out of the woods yet there. That's something we'll be watching out for. The FIs have pumped in some money. Does more of that continue or not is something I'll watch out for, specifically with regards to what happens with the emerging markets and Korea being classified as a developed market, etc., whether that happens or not. And July 9th, we have tariff-related news and developments. The line is in the sand and not, very strong. So around that development is something we'll be watching out for. But Nigel, good start to July series.
Well, that's right. The June series ended with a flourish. And now all eyes are on July, whether or not we can get back to those fresh all-time highs. And the momentum seems to be with the bulls as well, because you have all the constituents of the markets that are firing, whether it's Reliance Industries, Bharti Airtel, the Nifty Bank. All of them seem to be moving with a lot of momentum. And if you take a look at what history suggests, well, July is normally a good series. The last 10 series of July, the probability is that the Nifty, well, last 10 times, 90% of the times the Nifty has ended in the green, and 70% of the times the Nifty Bank has ended in the green, and the returns have been 2.5 to around 3.5% or thereabouts. So if that is the case, then all-time highs should be here in the month of July. However, there are 2 big cues that we are looking at. One is with regard to the tariffs. The deadline approaches in the next few sessions, and that's going to be the key monitorable on the global front. Besides that, on the domestic front, the earnings season is going to be important. Expectations are not very, very high, which actually is a good thing because that's what happened in the 4th quarter of FY25 as well. And actually, the street was pleasantly surprised on that front. Let's focus on positioning then. If you're looking at the Nifty open interest, the Nifty futures open interest, it's relatively heavier than what we have seen in the previous few series. So that's one data point to clutch onto. What about positioning? How are the FIs as well as the clients positioned at the start of a new series? Well, the FIs, they are net short. The clients are net long. But if you look at the stock futures, both of them are as long as they were in the previous series as well. But let's delve a little bit more into the index futures, particularly for the FIs. So the FIs, yes, they're net short with 35,000 contracts on the short side. However, the previous series, they were even more net short. And actually, I prefer when the FIs are net short because that gives you a reason for them to cover. Remember, in the last series, so majority of it, their net short contracts were around 90,000 to around 1 lakh odd. So I think we'll be missing those FI shorts a little bit this time around. What about clients? Well, they are net long, but they are net long positions as well, not as much as it was in the previous series itself. So that's how the FIs as well as the clients are positioned. If you're looking at levels, well, on the upside, anything is possible now because we have taken out crucial levels in terms of resistance. So for the Nifty, that 25,200 mark was a bit of a resistance mark. That's got taken out. So that becomes your first reference point. But otherwise, the 20 DMA is very, very important. You'll have to back yourself and say, till the Nifty Bank hold on to this 20 DMA, then maybe, in fact, we're in for better times. However, besides the Nifty and the Nifty Bank, I'm looking at two indices. The first one should be the metal index. Well, that's going to be important because it's at that golden cross. What is that? That, in fact, is, when the 50 and the 200 DMA, well, the 50 DMA actually overtakes the 200 DMA. And in the last 1 year or so, actually, have made no money in the metal index. So given the kind of cues we have on the global front, and things are looking a little bit better, I'll keep an eye out on the metal index. Anuj, my colleague, in fact, from CNBC Awaaz, had told me as well yesterday. And I will watch out for this because that 50 DMA is overtaking the 200 DMA. So I'll keep an eye out on this. The other one is the tech index. Since everything seems to be moving well, the tech index is still 15% away from its all-time high. So I'll keep an eye out on this one. Is there a bit of catch-up due on this one? So let's see. But I think, guys, we're set up well for July series actually to be a good one.
Okay, looking good for July then. All right, folks, so let's then kick it off with the equity call of the morning. And this one's coming in from Rhythm Desai of Morgan Stanley. He expects the growth data to improve, the RBI to remain dovish, and an earnings beat in the upcoming earnings season. He says most crucial cues continue to be global, including tariffs and wars. He adds a global recession or near recession would challenge Morgan Stanley's bullish call and keep equities off the highs. But that's not their base case. They are fairly bullish going into the second half.
All right, and we have Jeffrey Dennis, independent emerging markets commentator, joining us now. Jeffrey, good morning. Good to see you in. Global uncertainty, it seems like it is abating right now. And the July 9th deadline that there was with regards to trade, that also seems like it is a moving target from here on. Do you think the street will take heart from that? And the way the Wall Street moved yesterday, maybe it looks like we're in better times ahead for global markets and emerging markets?
Better times ahead, I agree with that. I think you mentioned 2 points there. My argument on geopolitics has always been geopolitics will only have a short-term influence on markets unless you get escalation, retaliation, escalation, etc. And if you get a major driving variable of markets that reacts dramatically, and of course what we're watching here is the oil price, which went up 20% and then came down 15%. So right now, it does look like geopolitics is beginning to fade into the background, although it's too early to be sure about that. As far as the tariffs are concerned, I completely agree with you. There is nothing magical about July the 8th, I think. I think it's extremely likely that if Trump wants to do it, given that I think we've had one deal, not 90 as he promised, we've had one deal with the UK, I think probably that deadline will be pushed back. And therefore, although tariffs remain a major risk to this market, I'm not sure we're going to get tremendously bad news on that on July the 8th. But clearly, the market wants to know that, and we will be waiting for it.
Okay. Hi, Mr. Dennis. Great to have you on the show this morning. So the thing is, the market right now obviously is extremely happy because whatever the final outcome on these tariffs is, it may just get pushed back from the looks of it. Do you see any risk at all on the table? I mean, it's almost blue skies. Geopolitics seems to be, at least there's no immediate blowout. Do you see any risks that we should be cognizant of?
Oh, yes. I think there are plenty of risks. And I think they're more developed market focused than emerging market focused because, as you've already said, since I connected with the program, the big driver of emerging markets this year has been the drop in the dollar. And I think that's going to continue. It's been a very, very good year for EM so far, up about 14% in dollar adjusted terms for MSCI EM. The risks, I think, out there are mainly tied, I think, to the US. Are we going to see a spike in inflation over the next few months because of the tariffs that were imposed earlier in the year? I'm not sure you're going to get a big spike, and I think there will be talk of Fed rate cuts again before too long. I think the other risk that we really have to pay attention to is what is known, of course, in the US as the big, beautiful bill, which is actually going to lead to a very large jump over time in the US budget deficit and also in US debt. And so I think how that plays out will be important. Now, right now, the bond market's rallied nicely and nobody seems to therefore worry about this BBB, so to speak, big, beautiful bill. But I'm watching what happens in Congress, and do we get this thing passed? And does that mean much, much greater risk for bond yields down the road? So I think those are the things I would focus on. Plus, of course, we really need to know that the geopolitics truly has settled down, but obviously that would be another risk as well.
Well, indeed, Jeffrey, good to see you win. The BBB, big, beautiful bill. We'll keep an eye out on that. But just in the near term, all eyes will be on the PCE that's due later this evening. And that's going to be important from what the Fed does as well. Now, I was looking at the Fed futures probability from around 13%, some optimistic view that was coming in with regard to 13% of, the views expected that we'll get a cut in July. That probability has moved to 23%. Maybe it's just kite flying, but if you look at the September meeting, out there the probability is at 93%, and that as well has moved up. So it appears that the market is bracing for rate cuts. Earlier there was some kind of skepticism on that front. How many are you factoring in, and what about the important data point that we're going to get in, the PCE later today?
PCE is very important. The best bet has got to be that it continues the good run of both CPI and PCE data we've had recently. That would be the best bet. I've argued all year for 2 rate cuts. I do think there's a growing possibility that we will get a rate cut in July. And this is part of my argument here. As you well know on the program, Jay Powell, Fed Chair Powell, is under tremendous pressure from the White House and indeed from Donald Trump with all his fatally ridiculous and rather rude comments about Powell. I don't think he wants to say too early that he's thinking of a rate cut. But as you know well, a couple of the FOMC members have come out in favor of a July rate cut. And I don't think it would take much in the way of some more softer economic data, and the July rate cut comes on the table. And therefore, I'm very comfortable with my 2 rate cut forecasts for the year, although whether it will be July or not, I'm not sure, but I think there's a decent chance it could be in July. All of this is very good for EM, because what the weaker dollar will do, which logically would follow a couple of rate cuts from the US, is push yet more money overseas, and the gap that's building up between EM and DM is going to continue to grow, I think, because the dollar's the big driver here, and the dollar's been very weak, and I think it's going to continue to be very weak.
In emerging markets, I'd like your thoughts on India versus China. The reason for that is because, everyone's wondering whether this trade deal happens or not. There is uncertainty around trade, etc. But, chances are that if it is a moving target, then China stands to benefit a little more than India because of its exports, or because the bilateral trade between US and China. In that case, would you bet on India's own domestic growth story or China's export story?
Well, China, of course, is not exporting anything like as much to the US as it was, and whether that, the last data point, to be fair, it was only one data point, was very, very weak. And how that plays out will be important, and therefore how the Chinese-US trade talks play out will be very important. But I would say the following. I think the Chinese market is still sort of in recovery mode from very, very weak performance for basically 3.5 to 4 years. It's very cheap. And on any particular good news, whether it's on trade or on the economy, the Chinese market does relatively well. But I stand by what I've said many times, including on this program, and that is that the Chinese economy is very, very vulnerable here because of 2 things. Number one, very slow consumer spending, and number 2, a major drag from the property market. And so I think the domestic risks in China are significant. In India, I just think it's a good story, and you've obviously gone through the numbers before I came, before the interview started. And I think India continues to be a very good domestic growth story. I much prefer India to China. One of the reasons why India has not done as well in dollar-adjusted terms this year is because the currency's been flat, whereas the Chinese renminbi has gone up a little bit. But on the other hand, I think India is attracting overseas interest. And as oil prices having shot up, which is very bad for India, now come back all the way or virtually all the way to where they were, the high 60s for Brent. That is at the margin very good news for India. So I would watch oil prices for India. I'd watch the geopolitics a lot. But I think the fundamentals in China are significantly weaker than they are in India.
Okay, that's good to hear, Jeffrey. That's really good to hear. By the way, I just want to also put on the table that there were some comments coming in from the U.S. Commerce Secretary, since we're talking about good cues for India. And the U.S. Commerce Secretary has said that the U.S. is close to finishing that trade deal with India. That's what he's been saying. But anyway, more on that later. Jeffrey, to round things up, I don't know if you've had a slightly closer look at the market here in India, the kind of companies that are there in the listed public space. Anything else that you'd like to add in terms of what the pockets of interest could be from a foreign investor perspective?
I don't really focus that much on sectors these days, but my brain, my logic would tell you that I think you've got to be in banks. You've got to be in technology. If the markets are going to do well globally, I think technology will do well in India. The growth story seems pretty good in the sense that there's room also for the RBI to cut interest rates maybe a little bit more. So I would think pockets of consumer discretionary probably look relatively good as well. But to be honest, I'm not doing a lot of work on sectors, but those would be some ideas for you.
Okay, all right. Really appreciate it. Thank you very much for joining us on the show this Friday and leaving us feeling fairly optimistic. So that's a thumbs up coming in from Jeffrey Dennis on India. With that, let's tell you what are the interactions lined up on the show today. At 8:35, we'll be speaking with the management of Capacity Infra projects. The company has received a letter of intent from the Saifi Burhani Upliftment Trust for a project in Mumbai worth over 600 crores. At 9 o'clock, we'll be in conversation with Kapil Singh of Nomura, India. Reports are saying that the anti-lock braking systems will become mandatory for two-wheelers. So what could that mean for the listed space? We'll find out. Krishna Sangvi joins in at 9:20 a.m. He is our market master of the day. At 9:30 a.m., we'll have Chanchal Rajora of Transformers and Rectifiers and Nikhil Nigania of Bernstein joining in to talk about some of the key developments in the power sector and the fact that the Mumbai market, for instance, Pune and Mumbai, could be getting more competitive. There are more players who are interested in hopping over in the discom space over here. At 9:50, Amitabh Malhotra of HSBC India and Bhavesh Shah of Aquarius join in to talk about the recent block deal buzz that we've seen. Towards the end of the show, in our special segment, Indianomics, Lata today speaks with the economist Praveen Krishna of John Hopkins on the likelihood of reciprocal tariffs after the July 9 deadline. Okay, on that note, we'll take a very quick break. Come back on the other side and all the key stocks to watch this morning.
Welcome back. You're watching us here on Bazaar Morning Call. Good start to the new series, and the Gift Nifty is indicating a start in the positive by over 100 points. So that's the kind of move that we're seeing after a big move that we saw in yesterday's trading session as well. So let's drill it down to individual stocks. We have Vivek joining in on why Tata Power will be in focus this morning. Vivek.
Well, good morning. Very interesting development as far as the state of Maharashtra is concerned. Just a couple of days ago, we had told you about how Torrent Power had evinced interest and had received a conditional nod from MERC to operate as a parallel electricity distribution company. Now, along the similar lines, you're actually seeing Tata Power also looking to enter the parallel electricity distribution sector in Maharashtra. They've applied to MERC, which is the Maharashtra Electricity Regulatory Commission, and they've applied for a license to operate parallel electricity distribution in 10 areas in the state of Maharashtra. So, what Tata Power told us was that, their total consumer base already stands at 12.8 million across Mumbai, Delhi, Odisha, as well as Ajmer, where they operate as the discom provider. So these new additions will allow them to cross the 15 million mark. So it's an interesting development, important development. Expect some green on the stock today.
Got it. Thanks a lot for that, Viv. Let's go across to Vama. She's here to tell us about some stocks and news. Morning, Vama.
Good morning, Nigel. Let me first start off with Hitachi Energy. They've received an order from Power Grid. They will be supplying 30 units of 765 kV, 500 MVA single-phase transformers, and analysts are suggesting that this order could be worth over 1,000 crores, so bodes well for the company. Mahindra Lifespace is the next counter that I'm watching out for. This counter is also expected to open higher because they have been chosen as the developer for a redevelopment project in Mulund, Mumbai, and the project offers an estimated GDV of around 1,250 crores. And lastly, keep an eye out on Digitide Solutions. Keep in mind that this is the first result that the company has posted post the demerger from Kescorp. The revenues was rather flat at 732 crores. The EBITDA margin, though, contracted by around 390 basis points. The EBITDA fell by almost 26% sequentially, and the company reported a net loss of around 1 crores. The bookings, on the other hand, in Q4 crossed 568 crores, and the management says that they're entering FY26 with optimism, a strong pipeline, and a clear focus on profitability.
Okay, all right, got that. And we've got Sonal joining in with some news on Gail. I think it's a what's the update here?
Well, there's an interesting note from Jefferies, and they talk about how there is a possibility of increase in unified tariffs coming in the next PNGRB meet. It's expected to come in soon, and this is where Gail had earlier asked for a 33% tariff hike. While that is the case, it would go up to 78 rupees per MMBTU. While Jefferies thinks that they are hopeful for a 10% increase in unified tariff, Gail is expecting a 20% increase versus the 33% that they asked. That is because their volume transmission has come down. Jefferies says a 10% tariff would lead to 13% increase in EBITDA and 26% increase in EBITDA if there is a 20% tariff hike. This is the key to watch for Gail, because if there is no tariff hike, that would be a key risk to the stock. So they expect a 34% upside from potential tariff hike in the target price. They have a buy rating on the stock currently.
All right. Thanks a lot for that, Sonal. And so good to have you back. Welcome back. Looking forward to having you more on air. Take care of the little one. But we missed your research. So welcome back, girl. Okay. All right. Well, let's...
Thank you so much. It was...
Got it. We'll catch up later today, Sonal. All right.
Yeah, that backdrop looks eerily familiar. I wonder where that is.
Got it. All right.
We all have been there, Mangalam.
All right. Let's move on. Let's get in Manisha Gupta, who joins in for a quick roundup of all the commodity and market action overnight. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we're looking at a second straight day of some steady moves coming in, a percentage point of gain in the overnight market. The whole focus now, of course, shifts on the Iran and U.S. meetings in the next week. We understand that the officials from both countries are meeting. And the focus also is on the July 6th OPEC Plus meeting, where Russia may support a production hike if needed. So that's a couple of things to watch out for. But the overnight market and the week, and by the way, the month of June, absolutely is about metals. Overnight as well, we've seen silver gain up by a percentage point, but it has been platinum, which is up by 5%. So when you look at the month of June, well, we've seen silver gain up by 11%, copper is up by 9%, platinum, palladium giving you returns like 20 and 30% for the month of June. And with the kind of fundamentals that we are working with, well, it continues to be a buy call for many of these.
All right, that's the word coming in on all things commodities. Copper prices at 3-month high. Nigel's been speaking about how the metals index will be in focus over the next couple of months. We'll watch out for how that pans out. With that, we'll take a short break, come back. How do your portfolio stocks benefit from the current developments in the world? We will connect with Siddharth Khemka of Motilal Oswal Financial Services for Fundamental Stock Talk. Stay with us.
Welcome back. You're tuned in to Bazaar Morning Call here on CNBC-TV18. Well, as promised, let's get in Sid Khemka, Head of Research Wealth Management at Motilal Oswal, on the show. Hi, Sid. Good morning. Good to see you. And as always, Sid, I wanted to ask you about a couple of names, but let's focus on tech pack first. Overnight, the Nasdaq has done well. The Nifty seems to be getting its mojo back. The Globe seems to be in a better space, but the tech index is 15% away from its all-time high. What's your view on the tech space, first of all? We'll be getting numbers in the next 2 weeks. And what's your top pick from the tech pack?
Yeah, good morning, Nigel. Thanks to be on the show and wishing everyone a happy Rath Yatra. So good day to be on the television. So if you look at overall globally, things are seeing some improvement while the US Fed rate cut has been paused. There is still talks of the tax cut that is still pending from the Trump's election promise. I think that could be a big positive for the overall tech spending. The management commentaries across have been mixed. If you see, Accenture has upgraded the lower end of the growth guidance, but new order wins are not coming forth. So clearly, near term, there could be still weakness as uncertainty persists. But what we see is that some of the Indian tech companies, they have a strong order book, execution is picking up, and given their niche presence, they are definitely seeing tailwinds towards their own efforts. So for example, one of our top picks, Tech Mahindra, has seen a management change, and we are seeing the transition under the new leadership playing out well. We believe that that could be a good, strong play. NCL Tech is the another preferred pick within the tier one case. Given it's a diversified book, we believe that's a defensive bet within the IT space, clearly with a strong diversification across digital infrastructure management and other businesses. Again, if you look at tier 2 is the space where the growth is much better and faster, and within that niche sectors such as again digital Gen AI investments are leading to stronger growth. So Persistent and Coforge, these are our two preferred picks within the tier 2 IT space. We see strong earnings growth over the next few years. In both of the stocks, at least 20-25% earnings growth, and we still see headroom for potential upside in terms of valuation. So Coforge is our top pick with a target price of 2,200, giving nearly 20% upside.
All right, so that's about Coforge. Siddhartha, I wanted your thoughts on Nika because they held their analyst day yesterday. They are speaking about growth in their beauty and personal care business, speaking about the fashion business, breaking even in FY26, mid-single digit sort of margins by FY28. And their own brands, a Nika house of brands, likely to compound at about 30%. The stock has been an outperformer over the last 3 months or so. It's rallied about 25-30%. How much more is in store according to you? Do you think it's good for more?
Hi, Mangalam. So, unfortunately, we don't cover Nika, but what we hear from the management meet, I think definitely the focus on in-house brands and the growth numbers that they are putting up, that should be helpful. As a space, we like the space, the e-commerce space, and given their niche presence in the personal care, we believe growth should be good. But overall, we don't have a view on Nika.
All right. Do you have a view on Eternal and Swiggy? Because Nika has announced its foray into beauty quick commerce. They've launched Nika Now as well. They will be fulfilling orders for beauty products between 30 to 120 minutes. They've launched that in top 10 cities or top 7 cities, if I remember correctly. You track the e-commerce space. You the e-commerce space on Eternal and Swiggy. What are your thoughts?
I think many players are jumping into the quick delivery business, and that's only to show that the model is effective and is a good solution for the Indian market. So we definitely remain very positive on the quick commerce. We believe it's a once in a generational growth opportunity or disruption opportunity in the way consumption happens in India and the way the delivery is happening. So near term, because of the increased competition of Zepto, the cashbacks that are giving, there is definitely some pushback in terms of numbers. Both Zomato, Swiggy have raised capital, and they have front-loaded the capex. So again, we believe that Zomato is our preferred pick there. We believe that the food commerce, food delivery business, that is a stable market leadership for Eternal. They're making cash flows there. Quick commerce, we believe that by Q2, Q3 should see improved numbers, and overall we remain very positive on Eternal. We have a buy rating there, and we believe there could be decent upside from current levels as well.
Sid, what about the real estate pack? What do you like from there? You have the new IPO, that is Kalpataru, that hit the market. A lot of smaller players as well have been rallying in the last few days. Some excitement in the real estate space. What is your preference? We had yesterday Baman Rustamji Irani who joined us, and he, as always, is sounding rock solid. Things are good. They'll achieve the numbers. What is your reading, and what do you like more importantly?
Definitely, I think after a pause, now real estate sector should again see improvement in the demand on back of the improved liquidity, whatever efforts that RBI has taken in the last couple of months, the sharp cut in interest rates, the CRR cut. I think that is only going to improve the overall liquidity in the system and lead to, and the lower interest rate should lead to demand, especially for the mid-tier real estate or mid-tier housing segments. Previously, we saw a lot of growth coming forth in the luxury and the upper end of the housing segment. But with the interest rates now coming down, we believe the mid-market housing segment, that should really pick up. And players like Godrej Properties, which are present across India, that is something that is within our top preferred pick, given its national presence, large presence in the high growth markets like Mumbai, NCR, as well as the NCR region. Apart from that, DLF is another stock that we like. It is among our preferred picks, consistently delivering growth, and we have a positive view there as well.
All right, we request you to stay on. You've spoken about real estate. Infrastructure is not too far away from that. You listen to this conversation and we'll get your views on the infra space as well. Capacity Infra is the first management on our show right now. They received an order worth over 600 crore rupees from the Saifi Burhani Upliftment Trust in Mumbai's Bhindi Bazaar area. We have the contract, which includes both core and shell works, as well as mechanical and electrical, plumbing and firefighting services. We are now joined by Subir Malhotra, who's the promoter and ED at Capacity Infra Projects. Thanks a lot, Subir, for joining in. Congratulations on this order win. The street needs to know a couple of things. One, by when do you execute this order? What are the kind of margins that you need, that you will be enjoying on an order like this? And thirdly, basis this order, what's the kind of target that you have for FY26? Not just this order, but all the others that you have as well. Because FY25, you missed your revenue growth guidance.
Good morning, and thanks to be back again. Yes, I'll answer the last one first. We finished last year with 2,400. I think that was quite in line with what we were expecting. We did almost a 23-24% growth last year. Coming back to this matter of the Saifi Burhani Upliftment Trust, we are extremely thankful to the SBUT Trust for giving us the third order that we have from them. And you can very well imagine executing an order in a crowded, high-density area like Bhindi Bazaar requires some extreme skills of execution, which I'm sure we have displayed in the last two projects, that they have reposed trust in us for the third one. The timeline of this project is the standard 30-month project, and we intend to finish it well in time. We are already executing or in midway through their second project as we speak. The numbers as we speak, as the end of the day, quarter one, as far as an order book is concerned, has been very interesting. We've clocked orders of more than 1,200 crores, out of which SBUT, Indus, Raymond's, and not to forget the high-speed rail data center has been part of the orders that we've picked up in the quarter one. We have a look ahead of around about 3,600 crores in this year as a quarter, as an order intake. I don't see why we should not drop that order.
All right. Hi, Mr. Malhotra. Good morning and good to see you, Ben. Give us a few basic numbers first. Revenue growth for the year, if I got that correctly, you said it'll be more than 20%. Could you just reconfirm that number? One. Two, what kind of margins are you looking at? And your working capital days, though it cooled off a little bit from higher levels, I think it's still around 200 days. So where do you see that number stabilizing at? Three big numbers.
So, I would stick with the projections that we have been giving in the past. 20% is very well in line. We did that last year. I don't see why we should not be doing it this year also. Our order book dictates that we should do at least that. Number two, the working day capital is a very non-linear kind of a line to monitor, because when you're executing big mega EPC projects, such working day cycles may keep on going up and down depending on the nature and the kind of the job that you're executing in that particular part of the time frame that you're looking at. As far as the bottom line is concerned, we have always maintained that a 70% EBITDA at the end of the day is what we will look at on an annual basis. We have always maintained that. We have achieved that in the past. And I don't see any reason why we should not be doing that in the present.
What is that number, sir? I missed that. What is
17%.
13%. All right.
17%.
17% is what you can do. All right. Between FY25 and FY24, you were between 16 and 17%.
That's about where we are. Right?
Yes. What about, labor issues? I have to ask you this because a lot of the infra projects, infra companies that have come to us, they've said that order inflows, not big problem. Costs, we're somehow managing. We're holding on to our, margins. Labor is a challenge, and that affects our ability to execute. Are you facing that as well?
I think they have absolutely hit the nail on the head. Labor is an issue. Orders, thanks to how the environment is in the market today, I don't think order book picking is an issue. The only way that you get over that is that A, you get to technologies where your dependence on labor is less, like get the quality and system formworks that we have always banked upon. B, you get to some kind of labor retainership initiatives on which you can then see that at least the labor that you are picking on, banking on, holding on, and trying to increase is there. But as we speak, yes, that is a challenge that the industry faces.
And how insulated are you versus the others because of all the measures that you just spoke about?
Well, I would say that we are better insulated than them, but it affects all of us.
Got it. All right. Mr. Malhotra, if we could focus on a couple of projects. I want to focus on the MADA project and CIDCO project. On the MADA project, I think you were to deliver the first 2 towers this month. You could correct me on that number with regard to the number of towers as well as the timeline. And on CIDCO project, I think you were looking at delivering the first 2 locations somewhere in the first half of the year. So an update on both these 2 fronts.
Yes, so we are looking to deliver both the projects. The first tranche of the delivery should happen in the next month or 2.
Okay, all right. So it's working according to plan. Is that correct?
Absolutely. In both the cases, both the client as well as capacity itself are strongly aligned to deliver the project within the next few months.
Okay, all right. And on the signature project, I believe you had started work on phase 1 and phase 2 was due as well. So how will this pan out?
So as per my last discussions with the client, phase 2 commences in September. And phase 1, I'm happy to report, we cast the raft yesterday.
Okay, all right. Just one more question from my end. How is the balance sheet looking with regard to the total debt? What is it currently in your books? And you could break it up for us. How much of it is short term?
I would like to say that our net debt to equity ratio over there is very well, say around about 0.1 or 0.15, fluctuating as we move. And the short-term debt is very well under control, especially with the new measures which the government has also taken out. I see interest rates coming down drastically, or at least hitting us positively on the balance sheet as we speak.
You could apprise us of what the absolute number is and what your repayment plan is also, because you have order inflow targets and execution
targets. That's not exactly available on a per debt basis with me at the moment, because there are various debts which are to be repaid in various time frames as we speak.
Okay, all right. Very quickly, sir, before we let you go, the stock was of so much of interest a few years ago, and then it lost its way a bit. But going by what you're saying, it pretty much seems that you're quite confident. What would your message be to the investors? Because they have seen levels of more than 400, then the stock corrected, and now it's holding at around 330 rupees odd. So what would your message be to your shareholders?
I would say always remain confident.
Okay.
Are you confident at 330?
Undoubtedly. Undoubtedly, we are deeply vested with it.
Did you pick up some stake at lower levels?
No, that's not something I can answer on.
Okay, all right. Good speaking to you, sir. Thanks a lot for joining in. We'll hold you at all these numbers and looking forward to chatting up with you in the time to come as well. Maybe the end of your first quarter's numbers.
Thank you.
Well, time to slip into a short break. On the other side, our technical experts are waiting for you. Shrikant Chauhan and Mitesh Thakkar will join in with their take on the index and individual stock calls. Welcome back. Hope you're having a good Friday morning and even better Friday evening. For the time being, let's focus on the morning. We have Shrikant Chauhan and Mitesh Thakkar who join us on the show. Hi, gentlemen. Good morning. Good to see you all in. Well, yesterday we had a late flourish and the markets ended at the high. That's always a good sign when you end the series at the high. Now, all eyes are on the July series, which historically, we put some data out. Historically, it's been very, very good. Last 10 years, beautiful, both Nifty as well as Nifty Bank. So there's optimism we get to fresh all-time highs. Mitesh, you go first. You think that's coming?
Morning, Nigel. So, all-time highs, even if they come, I think, one, they will be a very important supply pivot. I think, people always respect historical highs. But before that, I think there are a few challenges. There's a gap around 25, 700 zones, which is my target for the current ongoing upward. So let's see if we can get past that. But for the time being, I've been trying to take profits as we get closer to 25,700, 750.
All right, 25,700, 750. Shri, I'll have to go to Shri because, since morning, Nigel has been using a lot of these, you call Nige, Viv, Vama, Sud, Sid. So, Shri, your call on the Nifty?
Good morning, Mangalam. Good morning, Nigel. For Nifty also, I think the overall analysis is the same as Mitesh indicated, that at 25,750, the market is having good amount of resistance. But at the same time, the way the market has broken the range of nearly 750 points, one thing is very clear that we are heading for 26,000. And in case if there is any correction, then certainly we should look for adding or taking position in this market close to important support levels. So 25,400, 25,350 is the area where we should look for taking long positions in this market. But as we are very close to the important resistance level, I think here again, we can expect some activity in mid and small cap companies instead of any large cap companies. Because whenever there is a rally in the market, we see buying interest in large cap companies. And as the market stops at important resistance level or because of uncertainty, we start seeing activity in mid cap and small cap companies. So similar sort of trend we can expect today.
Okay, so buy all dips. That's the advice coming in. Gentlemen, good morning and happy Friday to both of you. Let's talk about individual stock trades as well. Mitesh, what would you go with?
Yeah. I have all buy calls today, just like last couple of days. Adani Enterprises is a buy with a stop at 25.60 for target of 26.45. Cement as a sector has done well, so Dalmia Bharat is a buy call. Keep a stop below levels of 21.60. Look for targets of around 22.50. Also a buy on Axis Bank if it crosses yesterday's high. I guess it might happen in the opening. So buy about 12.40. Keep a 15-point stop loss around 12.24 and 12.75 is the target area. And Bajaj Finserv is the final buy call. Buy here to stop at about 2030. Look for targets of 2110.
All right, so there's Dalmia Bharat, Bajaj Finserv, as well as Axis Bank on his buy call. But Surabhi, I thought you would take the trend forward and perhaps call him Mitts. But
I don't know if Mitesh would necessarily, like that. So that's why I refrain.
It's Friday. I don't think he would mind.
Okay, Mitts. Okay, that's the popular house call. I'm sorry, Mitesh, but no, we'll go back to Shrikant.
Oh, but are you okay with that?
Totally fine.
Totally fair. Okay. Shri, your
National
individual
television,
stocks.
you're putting him on the spot. Shrikant, go on. Your stocks.
Yeah, Surabhi. We like a few metal companies because there also we are seeing good amount of buying interest. Based on the rally in the metal market, we can expect rally in Vedanta. which is around 455, 456 levels. There I'm expecting again the stock can move towards 470.75 where it has resistance. So at current levels, it's a decent buy with a stop loss at 447. The other stock which we like is Dixon Technology, which is around 14,300. It is forming some consolidation at the bottom of the fall. And from here again, the stock can move towards 15,500 or 16,000. So it's a buy at current levels with a great risk reward ratio. We can keep a stop loss at 14,000 for creating any long position.
Okay. All right. Quick question, Sri. Wanted to ask about, since you pointed out Vedanta and the metal index, we pull up a chart yesterday. That one got its act together towards the end. But if I plot a one-year chart, still it's unmoved. We were highlighting today that the 50 DMA has crossed the 200 DMA on that one. Do you think the index is good for more? Obviously, there are various variables. We don't know what Trump does next. You don't know what's going to happen with regard to global uncertainty. But one factor that's supporting it is the dollar index is soft. So your take.
Yeah, absolutely. The way the dollar is weakening from its highs, and if we consider the dollar index, the chart of dollar index, then based on that, I'm expecting dollar index may fall to the levels of 93 or 92 in coming few weeks. So it will take some time, but gradually I'm expecting dollar index to come back to the levels of 92, 93. And if that is going to happen, then this will help all these metal companies to do well, especially Hindustan Copper, Vedanta. I think these are the stocks which should be on our radar for next few weeks.
Wow, 92, dollar index, and this is over what time frame, Shrikant?
In next maybe max 2 to 3 weeks.
2 to 3 weeks from 97 to 92. That'll be very interesting to track. Shrikant, Mitesh, thank you so much for joining in. We'll come back with stocks at 10 as well. With that, we'll take a short break, come back with the pre-opening. Also with us will be Kapil Singh of Nomura, as reports suggest that the anti-lock braking systems will be mandatory for all two-wheelers. Which companies stand to benefit from that? Kapil will tell us. Back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. We're counting down to market pre-open and market open as well. 16 minutes and a little more over 30 seconds remaining for the market to open. The GIFT Nifty indicating a 100-point jump at start itself. Sid Nika still with us. Sid, you heard what Capacity Infra had to say to us. Do you like that stock? And in general, the infra space, do you think it's ripe for an up move from here on?
Yeah, definitely. So again, we don't have coverage on Capacity Infra, but overall what we are seeing is that ordering momentum has been healthy, especially if you look at in the T&D space, renewables, as well as the defense segment. Even our economists suggest that that the central government capital spending has surged to the highest ever monthly level of 2.4 lakh crore in March. Even for FY26, they have front-loaded the capex spending even for April, May. So spending in April stood at 1.6 lakh crore, which was up 61% on a YoY basis. Obviously, last year, April, pre-election, there was not much spending. So definitely, that's a big positive for the overall capex theme. As I said, some of the key segments that is witnessing strong growth is the T&D segment, renewables and defense. Players like L&T, Kalpataru, KEC are benefiting from the strong pipelines, plus the defense overall global theme that is also playing out. So our preferred picks within the overall capex theme, L&T, which is a top pick with a target price of 2,950, and then KEC International in the T&D space.
Okay, so some of the T&D players is what you're going with. Siddharth, hi, good morning, good to have you on. On financials, what are you doing? I mean, yesterday, the whole market was lit up. Obviously, when you got 12,000 crores of FPI buying coming in, so everything was up. But give us the one or two top names. There could be banks, non-banks, lenders, even non-lenders for that matter. Maybe some ideas here.
Yeah, definitely. Good morning, Surbhi. So I think, yes, that is a big theme that is playing out this year. It's a purely domestic theme, so it's not affected by the global volatility and the geopolitical concerns. Plus, RBI has taken a lot of efforts to improve liquidity, bring down the cost of capital, that is supporting the entire theme. So overall, what we expect credit growth to improve, NIMs to stabilize, and then again, especially for the NBFCs, NIMs will see some improvement, and followed by banks where the entire effect of the CRR cut as well as the liquidity will start taking place. So definitely banks are something that we like. ICICI, SBI, HDFC Bank are our preferred picks. Within the lending NBFCs, what we like, Bajaj Finance, we believe consumption credit will go up, and being the market leader, that would continue to do well. Shriram Finance and Chola, these are some of the other stocks that we like. Within the non-lending NBFCs, capital market as a big theme, we are seeing market volumes going up. Again, a lot of IPOs have started coming in, so you will have traction in the CDSLs of the world, the AMCs have started seeing a lot of interest back, and finally you have the AB Capitals of the world, where so L&T Finance, AB Capital are some of the other themes, and CDSL are some of the other themes within the overall financials that we like.
Okay, all right, got that, Siddharth. Thank you so much for the ideas this morning. You have a good trading session, and we'll connect again soon. We are just about getting up to 9 a.m. First of the pre-open rates are coming in. They're sort of suggesting that there could be a cool-off given the big run-up yesterday. But let's see. I mean, all the experts have been telling us that this is a buy the dip market. So will this dip get bought? I mean, let's see if it indeed is a dip when the actual opening happens. As those rates settle, let's put the spotlight now on the two-wheeler space. Autos is what we're looking at. And this is because reports are suggesting that anti-lock braking systems could be mandatory for all domestic two-wheelers from 2026. We have to remember that the ABS systems help prevent wheel locking up during sudden braking. Nomura believes that prices can see an increase of 3 to 5% if the companies decide to pass it on. To talk about this, what the ramifications are, we have Kapil Singh, auto equity research analyst at Nomura. Kapil, thanks so much for joining in. Good morning to you and happy Friday. So, I believe that ABS was anyway mandatory for bikes above 125cc, but the bulk of the Indian market is below 125cc. So, what's the thought process? Because the rollout time is also very short. I mean, we're talking 1st July 2026, 6 months. First of all, do you think it's feasible? Is it possible? And I'm guessing it has to be, of course, prospectively, not retrospective. So, what are the implications for companies?
Thanks, Abhi. Good morning, everyone. So, as far as ABS is concerned, yes, you're right that it was present only in vehicles more than 125cc. But less than 125cc and below forms almost 85% of the market. And the price points there are lower, and therefore the customers are also much more price sensitive. So that was one of the reasons, that is one of the areas of concern. Having said that, they do have an advantage for the customer where, as we said, wheel doesn't lock. So from a safety perspective, it's important. We do think that the timeline is steep, but again, these are news reports. There is no confirmed notification that has come from the government. So we will wait for that. Maybe there is some discussion with the manufacturers and the suppliers on getting the capacity in place, because I'm sure, this kind of capacity will take some time to put in place. So maybe, there can be some relaxation that is possible if the regulation were to go through. But that will depend on the discussion that happens between the manufacturer and the government.
Yeah, I mean, it's not a new technology. So, yeah, you're right, because it's been there. It's applied to higher cc bikes. So it's not a new technology. It's a question of having enough capacity to, roll it out on all bikes. Now, let's talk about this price increase. According to, I think these are, I believe, your estimates, a 3 to 5% price increase. Tell us more about this. And again, will it be palatable?
Yeah, so our estimate is currently, it will require, even if there is a single channel ABS, it will require one disc and the ABS. The cost without the taxes could be about 3,000 rupees for the vehicle. There can be some variations depending on the category of vehicles, but this much impact is going to be there. We have noticed that the customers right at the lower end are more price sensitive. So in some cases, historically, when manufacturers have introduced variants like disc brake, the adoption rates have not been high. So one of the things we conclude from there is that customers are very price sensitive also. So it does increase that concern that there could be a demand impact. Sometimes in the past also we have seen that when regulatory costs increased because of insurance or ABS, CBS, there was some impact on demand. So that is possible. We think there could be a 2 to 4% kind of demand impact possible for the industry.
You know, we'll ask you to hold on, Kapil, because there's important breaking news at the bottom of your screen. This is something that we got an inkling into yesterday afternoon as the markets were, just about to close. It was the possibility that JSW Paints will go ahead and acquire the entire stake of AkzoNobel India. The promoters were looking to sell, the foreign promoters, and that exactly seems to have happened. So JSW Steel will go ahead and acquire 50.46% and 24.3% respectively from the promoters AkzoNobel at a price of 2,762 rupees. Remember, AkzoNobel's last traded price was close to 3,215. So this price is at a discount to that. 2,762 rupees is what JSW goes ahead and acquires AkzoNobel's business for. And over and above that, there will also be an open offer. So this is what we have now. The deal which was in the works for a very long time. A lot of players were reported to have bid for AkzoNobel. Goes ahead and JSW, Paints goes ahead and buys it. In the past, Parth Jindal has said that they have ambitions for the paint industry or the paint sector to grow. At the same time, they also have ambitions for the paint business to be listed on the bourses itself. AkzoNobel, of course, is the fourth largest paint player in the country right now, has an important premium brand, Dulux, where they have a higher market share than what they have in the mass products. And this is a positive. From a listed player standpoint,
the pricing, which is really interesting. At the peak, I was looking, AkzoNobel had rallied to over 4,000.
Yes.
It anyway cooled off from there, and the deal has been done at a price even lower than
so which is what
now.
So which is what the question is all about, the industry itself right now. What is positive for JSW Paints is that they didn't have to pay top dollar, but all the other paint players who had the opportunity to go ahead and buy this passed this over, which means that valuations at these levels did not make sense to the current paint players itself. So what's good is that this has been a deal which is done at reasonable valuations for JSW Paints. What is also good for the existing paint players is that they didn't go ahead and buy it, which means that their balance sheets are fairly good. But now you have a large conglomerate other than the Birlas, which has now a bigger seat at the table. Because JSW Paints, yes, they've been in the paints business for the last 6 to 7 years. The last reported number that we know of, what Parth Jindal had told us, was close to 2,000 crores in revenues that they had. But mind you, 60% of those revenues came in from JSW Group itself. So decorated paints accounted for about 800 to 900 crore in revenue. So 5 years of being in the industry, they did not cross 1,000 crore in organic decorative paint revenue. Now they've gone ahead and acquired the fourth largest player. So they've gotten a bigger seat at the table. How aggressive will they be at a time when everyone else is looking to, protect their turf, grow the industry, grow their market share, and at the same time do it profitably is something that we'll most definitely watch out for. So for starters, good for other players that they didn't acquire it because their balance sheets are ready for a fight. But for JSW Paints, they got it at a reasonable valuation. They got a higher seat at the table. Interesting times, colorful times.
Just going by the numbers that you're giving us, Mangalam, 2,000 crores is what JSW Paints had done, right? And only 800 crores was X of the group companies. And now they'll acquire a company that has around 4,000 crores or thereabouts. So from 2,000 crores of revenues, they go to around 6,000 crores approximately. And more importantly, the chunk X of the group will go to around 4,800 crores, just rough numbers.
Yes, and the important part here is that Parth Jindal has been talking about the IPO of the paints business. But now could there be a case where AkzoNobel is acquired by the JSW Paints business, they rename the company to JSW Paints, and they reverse merge the unlisted paints business into this, so that prevents them from the entire process of the IPO itself. So by virtue of buying a listed entity, they become a listed company themselves.
And I don't think the paint sector has been more interesting in the last many, many years, because I just want to remind our viewers, again on the table, the big fight. So there's Asian Paints, there is the Birla Group, and now there's JSW. And remember, the Birlas had moved the Competition Commission of India against Asian Paints, saying that they're abusing their market dominance. So I think there's a big story playing out here, and JSW is making its seriousness, its intent very, very clear.
There is a big story playing out here, but it will be very interesting to see how much bigger a dent will JSW Paints make as well. Because, again, I'm reiterating, the last 5 or 6 years, including AkzoNobel, if they do about 6, 7, 8,000 crores as well, that's less than 10% of the paint industry right now, which is anywhere between 60 to 80,000 crores, depending on what you're looking at right now. But more importantly, the aggression of the Birlas, will the JSW Group be able to match that? Because in the first year of operations itself, Birlas claim to have gained almost 6 to 7% of the market share of the paint industry. Here, by acquiring another company as well, you are just at low double digit or double digit at best in terms of market share. So with the Birlas having a target of, 10,000 crore in paint business by year 3 of operations and EBITDA profitability, they are walking that path, and they are walking that path very aggressively.
So remind us of the revenue again, just so we have the pecking order right.
So we have the pecking order right. Asian Paints would be close to around 35-40,000 crores.
Almost 40,000.
They are above everyone.
Yeah, absolutely.
Birlas are targeting 10,000 crore in revenue by year 3 of operations,
which will make them the second biggest.
Which will make them the second biggest or third biggest in terms of revenue. Then you have Berger, which is around 12 to 15,000 odd crores. These are numbers that I'm remembering off memory.
Top of your head.
So they might not be
unfair
accurate.
to mong them, but
the only thing that I'll be looking at from here on is whether they grow profitably or not, and what happens to the overall market share of JSW Paints in the industry. Because 6 to 7,000 crores would keep them at 10% market share. Can they grow beyond that or not is a big question.
All right, Mangala, I'll give you further time to just look into those details, and all the numbers were bang on target with regard to Asian Paints, Berger Paints, as well as the deal that just announced. But we have Amnish Agarwal, Director Institutional Research, PL Capital, joins us on the phone line. Hi, Amnish. Thanks a lot for joining in. What are you making of this deal? The deal has been announced. It was speculated that JSW Paints is in the forefront. They've gone ahead and they've bagged AkzoNobel. What do you think with regard to the pricing that it's been done at, and how does it change the dynamics of the industry?
You see, the pricing actually it's a 15-16% discount to CMP, and this is even when your AkzoNobel was not trading at a premium to other players. So the pricing to that extent doesn't seem to be that high. That is one. The second, in terms of the industry dynamics, I think it's going to be the most fiercely competitive scenario than we have ever seen in the paints industry, because already we are witnessing a lot of competition coming from Birla Opus, and now AkzoNobel, which was I would say an MNC, but they actually never tried too hard to gain market share or do anything which is very extraordinary. Now with they falling into the hands of JSW Group, which is very aggressive, and on their own they have been making quite a lot of efforts. I think now it will become much more complicated in the entire paint industry. And in terms of margins, in terms of growth and all, I think the market shares will continue to be redrawn for the next 2 to 3 years.
Amnish, market shares aside, I have to ask you about for AkzoNobel shareholders. You said that the stock wasn't trading at a premium to peers anyway. With JSW acquiring it, do you think a case for a re-rating comes by, or do you think the street will await the moves from JSW Paints before making any investment decision on AkzoNobel?
You see, I think we will have to wait and watch what is the exact structure and how JSW handles it. Okay, but definitely it's a long-term positive, but in the near term there is nothing much for the shareholders from that.
So very quickly, Amnish, for paint stocks, more downside in general?
You see, the sector has already seen a lot of correction for most of these stocks in the past couple of years, and I think they will remain weak to sidelines for quite some time. The incremental weakness will depend upon how much
on the pricing intensity, the competition,
share, margins, yes, how the competitive intensity plays out in the market.
Absolutely, take that point. Thank you very much for that quick overview. Let's actually start with the paint stocks. Let's look at what color they're choosing. Asian Paints is flat. Let's pull up Akzo itself. Akzo's at 32.10, and remember, it's turning negative now. The deal itself has been done at sub 3,000. So let's see how it plays out. Let's pull up Berger, Kansai Nerolac. Let's get all of the paint stocks up on the screen. Axo is not falling too much. Berger is also flat. Most paint stocks actually flat. Perhaps, like Mangalam has been saying, the market had an inkling of this coming all along, so it's not coming as a big surprise. Now Axo is seeing a little bit of red as the market digests the news. Yeah, a little over 1% down on Axo Nobel. So that's what we have.
So now my sense is that the Axo Nobel stock would be, in the red all the way until, the deal price is there, and that acts like a floor price for the stock from here on.
Yeah.
All those who were bidding the stock higher, hoping for a deal and an open offer to come by at prices earlier at which Axo Nobel was trading, or at a premium to what it was trading, have their hopes have been quashed. Absolutely. It is at around 2,700 rupees per share. So those people might be unwinding their positions, but they won't until the 2,700 mark is, holding on. That will become a base price. And from yesterday's high as well, the stock has seen a bit of a knock. Ever since, the story came by that JSW Paints will go ahead and acquire the company. I remember Ashwin saying on the air as well that they're valuing the promoter's stake at 9,000 crores. As against the 10,000 crores that it was yesterday. So from those levels, the stock has seen a bit of a knock. Still holding.
I know. Actually, I'm a little surprised that the market isn't pricing it, because now you have a price. The asset has been priced at 2,762 rupees, but the market price is still holding higher, which is interesting. We'll keep analyzing the story as we go forward. Let's look at the rest of it then. 50 points higher on the Nifty, so the bulls continue to show up their good form. Let's see what's taking the market higher this morning. There's L&T, 1.5% up. There's Tata Steel. There's State Bank of India. There's Hindalco, NTPC. So it's a complete mix of stocks and sectors really out there. Tata Motors is having a decent day. There's Apollo Hospital, Axis Bank. So it's a good mix. Reliance is still contributing. Infosys is contributing on the upside. State Bank of India and L&T. So these are some of the heavy hitters this morning. What is not contributing is HDFC Bank. Pretty, decisive in its down move today. Over 1% lower. And then there is Cipla and SBI Life. These are some of the other stocks which are quiet as we speak. So Bank Nifty is playing a little bit of a spoil sport, keeping a check on the Nifty overall. Nigel.
Well, that's right. In terms of stocks on the broader markets, Dixon, that one is getting its mojo back. It's up close to around 4%. Equerris have come out with the note. They have an ad rating on the stock. They remain positive on the stock. They believe there are multiple near-term positive catalysts. And they also say some of those concerns are premature in nature. So that could explain one of the reasons the stock is up close to around 3%. So good up move on that particular name. What else? Metals are doing well as a pack. We had highlighted this earlier this morning as well, that technically, you have the 50 DMA that's moved above the 200 DMA. And the world seems to be in a better place if these tariff tantrums are gradually easing out. At least that is the hope. For the time being, the metal index, which hasn't done anything in the last 1 year, well, that's up close to around 1% or thereabouts. So China remains the problem. We don't know what's going on that front. So that's the other pocket that I'm looking at. A few more names that are moving around. Prime Focus, we don't talk about this name very often. Stock is up more than 10%. So solid up move is what we're seeing on that particular name. Western Carriers, another one that won an order, I think, yesterday. I think today as well, there was some small order win out there. That stock as well is opening up higher. And Mobiwick, yesterday it saw a big recovery from the day's low. Today as well, it's building on to those gains. From the broader markets, Brainbee Solutions has come in for some profit taking. Last few trading sessions, it's been moving like a rocket. Today, it's cooling off a little bit. And just one word on stocks like HDFC Bank. Yesterday, they ended with a flourish. Sometimes you see some of these stocks that do that in the last hour of trade at the last day of a particular series. The next day, just for that day, they realign themselves just to adjust for what they did in the previous trading session. So HDFC Bank, I think the trend is up, but I think it, just readjusting itself. Just one word, guys, with regard to this paint deal. I'll keep an eye out on JSW Cement's IPO. Money is going to be required. The group, I think, could look at fast-tracking those plans. Just a comment that I think.
All right, we will keep an eye out on that itself. Meanwhile, the Nifty Bank, despite the HDFC stock being lower, is contained by its losses, just about 50-60 points. That's because SBI is doing well. Axis Bank is doing well. SBI, of course, aims to raise about 25,000 crore rupees via a QIP. Torrent Pharma is one of the stocks which is up around 3.5% as well. There's a note that has come in from JP Morgan this morning on the stock. They've upgraded the stock. The target price is close to around 3,800 rupees. So that's one of the bigger gainers in the broader markets. Siemens is one which is coming in for some buying as well, up close to around 3%. We continue to see some traction being built on Vodafone Idea. Ever since the comments that have come in from Jyotiraditya Scindia. You know, the stock is up around 12% this week. This morning starts with gains of about 2%. And rail stocks do fairly well this morning as well. So Titagar is up higher in today's trading session. Translay Lighting is the other one. Another stock not regularly spoken of, but a big mover this week is Bajaj Consumer. They announced the appointment of a new MD this Monday, and the stock was locked in upper circuit, a 20% upper circuit on that day itself. Continued to hold on to its momentum, currently higher by about 4% on Bajaj Consumer. It is it's almost 30% higher this week itself for that stock. So good time to bring in Krishna Sanghvi, who's the CIO equities at Mahindra Manulife Investment Management. Thanks a lot for joining in. The market looks good. Last week has been good. The global, picture seems to be a little more clearer than what it was, say, about 10 days ago, Krishna. But the big news that came this morning was on the paint sector. So let's start with asking you your views on consumption and the paint sector in particular. It's been a long summer for all these paint companies. Ever since Birla's announced their foray, there has been a multiple de-rating for a lot of the incumbents as well. And now this morning, there is another deal that has come in. JSW has gone ahead and bought AkzoNobel. In light of this disruption, what are your views on consumption and paint stocks in particular?
Yeah, no, actually, maybe this disruption, as you mentioned, is perhaps, one good indicator that, Indian consumption story is pretty much intact. Yes, there are new players entering, and, for any segment, when there are new players entering, there can be some sort of market share, grab kind of competitive activities which plays out and which is pretty normal. But the big picture is, yes, there are quite a few sectors or subsectors of consumption where new players are looking to enter. And so look at consumption in slightly bigger details. Yeah, what all we need perhaps for consumption is, let's say, more money with consumers. That's partly played out through tax reliefs in the budget. People are going to have more money as the year progresses. The amount actually goes up. On the other side, we also have a situation where in next 6 months or so, the pay commission announcement is likely. Consumption had a slightly weaker patch, even from a numbers perspective. YOY, the base has been weak. So I think broad picture on consumption, core India, demography, India earning, stroke, tax relief, more money with consumers. I think that's going to play out. So consumption as a broad space, we expect things to improve from now on.
The stock of the morning definitely is AkzoNobel. What a big recovery that we've seen from the lows, despite the offer being a lot lower than the current market price. Maybe the street believes that the new ownership.
That's the only logic that I can find, Mangalam.
That exactly is the only ownership.
It's a deep-pocketed, serious player that means business, that can put more money to work, that can perhaps withstand even a pricing war if one were to come through. And I mean, from AkzoNobel, who wanted to sell an MNC company, not looking at too much of interest maybe in India, at least in this part of the business. Now you have a serious corporate entity backing it.
I'm not too sure whether it is about the deep pockets of the conglomerate that is backing it, etc. It's more of a relief that the deal is done now, because up until the deal would happen, people would be skeptical of bidding into AkzoNobel, knowing that at some point someone will go ahead and buy it. So irrespective of who's bought it, and I'm sure there's strong people, whoever buys it is a 9,000, 10,000 crore asset, will not be shallow pocketed, but the ones who buy it, the fact that the deal is over makes people now a little more, relieved that, this is what the future of AkzoNobel looks like. The stock has been under pressure. Maybe there is a bet that needs to be taken.
Let's ask Krishna. Krishna, we're not asking you to, comment on any individual stock, but we're just trying to find rationale. Typically, when deals are announced in the market pays a lot of attention to the price at which the deal has been done. Here, that price is 16% lower than where the market was after a big correction in paint stocks. And now the market's taking a very favorable view. How would you read into this? What are your thoughts on the paint space?
So I think let's not read too much into the immediate price reaction, just on the deal being announced, because this doesn't really add value, because even the buyer perspective, obviously they've not bought for a single day kind of thing. It's basically a new business opportunity for them. Paint as a sector, as you mentioned earlier, I think consumption play is pretty much, the core story. We have a nice combination of, whatever I say, house durable, the house paints going on, maybe infrastructure is improving. So paint is structurally a good story. Competitive intensity can, decide a little bit shift of market shares or, margins, profitability, etc. But that does get, captured in market valuations.
Hi, Krishna. Good morning and good to see you. One problem has been the kind of supply of paper. Day-to-day basis, $500 million, $1 billion worth of sale that's coming in. Actually, for one, I'm happy that we're going to be seeing, the earnings season that will take shape in the next week or so, because a lot of these companies will go into silent period. If that's the case, and if liquidity continues the way it is, do you think there's a chance that you'll have the broader markets actually that will outperform?
Yeah, fair thing in the sense that let's look at the supply of papers is continuously on the rise. If the numbers are broadly right, I think in last 6 weeks or so we would have got roughly 1 lakh crore worth of supply, either primary or promoter sale combination. It is a large supply. Luckily, markets are able to absorb, and despite that supply, markets are again making newer highs. So that's possibly telling us the markets are clearly in a bull trend. Maybe global markets are equally supportive. It's not only India. Let's not forget, it's not only India. Almost all major global markets are making newer highs for current calendar year, and India is no exception. So to that extent, yeah, markets are in bull phase. Some of the supply is being absorbed. Two combination, you have a nice free float increase in the market, which somewhere will help rationalize valuation. So in a way, yeah, supply one needs to be slightly worried, because at some stage this supply takes money away from existing stocks. So demand supply dynamics will matter. But yeah, for now, the broad bull market phase is on. Yes.
Okay, got that. So Krishna, then tell us about your preferred sectors. And definitely mention in a word on defense, because of the last, I think, 6-7 months, this is the one pocket we spend so much time talking about. Stocks have done well. For now, at least, the war issue seems to have receded in the background. What are your thoughts?
Yeah. So I think from a sectoral choice, BFSI, comes in as one of the name. We got a nice combination of, regulatory support. Reasonable rate cuts have happened. Money supply is increasing, so liquidity is back in system. So if we add those two, which is the core requirement for a BFSI, is a space to do well. So that's one particular space. I think consumption, I did mention earlier, is equally a sweet spot going ahead because of multiple factors which I mentioned. Defense, yeah, it's actually India's core story which has emerged post COVID, when government decided to go for some sort of that self dependency, Atmanirbhar, for India's defense needs. And quite a few Indian companies, have shown their ability, or on the way to show their ability to get into export market for defense. So structurally, yes, defense also can be good. Valuations, one can always, wait on some stocks for a better opportunity.
Right. And what about, the banks? A lot of people are finding value in financials right now because every other pocket seems to have run its course or fraught with uncertainty where valuations are compelling. They believe that if there is any growth that is likely from here on, banks stand to benefit the most. What are your thoughts there? Do you prefer private banks, public banks, or you look at NBFCs as an option?
Yeah, so the bigger piece is, let's say, lending. So if credit growth is back in system, I'm sure, banks and NBFCs both have a participation in growth. From a cost of fund angle, maybe, benefits to NBFC may be slightly ahead of benefits to, banks, because the way the liability side is structured. But, from a very good angle we got is, when this rates hike cycle happened in 22-23, we got a nice roadmap of how assets gets repriced for a bank and how liability repricing follows with some lag on of 3-6-9 months based on the liability profile of the bank. So my guess is NBFCs can be a near-term beneficiary of a lower rates on their borrowing side, while banks should follow with a 6 to 9 month lag at max. So if I look at FY27, maybe which is possibly a full relevant year for this purpose, I think both banks and NBFCs as a lending combination will have a nice sweet spot of liabilities repricing already having happened, and the credit growth being back in system. So good earning growth for FY27.
All right, Krishna, final question before we let you go. The fear is, towards the end of this year, again, we get into election mode. Bihar will kick it off with, I think, the state elections. How are you positioning with regard to, what are your expectations, both on the fiscal and the monetary front? RBI has given a good booster shot for growth, and they've shown that they are pro-growth. On the fiscal, it seems that, maybe there's limited headroom now, and particularly with these state elections coming about, again, it, keeps sentiment subdued. Your expectations on both these two fronts?
Yeah, so at macro level, from a fiscal policy perspective, the central government has reached a stage where we actually on a fiscal consolidation, nice way to reduce fiscal deficit by, 20, 30, 40 bips based on the yearly, situation. So that roadmap is intact, which is healthy fiscal consolidation, and that should support the broad macro for the country. So that's a good part. I think clearly RBI policy on monetary, accommodative stance which they took, and very nicely, the quick quantum of rate cuts in terms of 100 bips in just 4 months, as well as nice liquidity expansion. It should play out for economy going ahead. Elections, do have on the card in India, but we've seen in elections almost every 6-9 months happening in India, because 29 states, almost everybody goes through a 5-year cycle. So election part, honestly, markets, have taken into that stride over time.
Okay. All right, Krishna, we'll leave it on that note for this morning. Thank you very much for joining in with your perspective on the market. And the market's been actually holding up okay, but there is a little bit of profit taking coming in, and you'd expect that because it's been a good week. We've been already rallying almost 2%, barely 3% off the all-time high. So there's some, hint of caution, some profit taking. Maybe that's not too bad at all. Where is the money coming off? Bajaj Finance, there's Bajaj Finserv, there's SBI Life. Financials, remember, rallied very hard yesterday. So there's a bit of a cool off. On HDFC Bank, just to add to the point that Nigel made earlier, someone just pointed out this to me a while back. It's also gone ex-dividend today, and the dividend was 22 rupees. So there's that factor playing out as well on HDFC Bank. So that's pretty much where we are with respect to the market. SBI actually is, however, keeping the other end fairly all right. SBI is up 1.5%. It is the nifty winner at this point in time. So that's how it's playing up. Mid-cap index still in positive territory. Well, the sector that we're now putting the spotlight on is the power space, because there are, fairly interesting developments. Torrent Power has received an important go-ahead from the Maharashtra Electricity Regulatory Commission to offer parallel distribution services in Pune, in Nagpur, and in the Mumbai MMR region as well. Do note that this decision marks the first step for the company to operate as an alternative electricity distributor alongside existing discoms. And that's not all. Now we know that Tata Power has, bigger plans for the rest of the state, for all of Maharashtra, and they're looking at getting into parallel power distribution as well. So what does this mean for power generators, distributors, or entire transmission set up in terms of fresh capex? What is the opportunity? Let's discuss this. We have Chanchal Rajora, Group CFO and advisor to the board at Transformers and Rectifiers. And we also have with us Nikhil Nigania, Director and Senior Analyst at Bernstein. Gentlemen, thanks very much for joining in. So this is interesting news. It's a good development. Obviously, it's great for consumers. Choice is always a good thing. Nikhil, let me get your opening thoughts in on this whole setup of being a parallel operator. Let's talk about, say, Mumbai, where Torrent Power wants to get in, where the Adanis are already present, Tata Power is already present. Is the market big enough to make an inroad? And then likewise for the rest of Maharashtra, where Tata Power wants to expand. Your thoughts?
Sure. So in terms of the regions these three players are looking to target, it's not really the part of Mumbai addressed by Tata Power and Adani at present. It's more areas where they compete with the state distribution company, MECDCL. So that is a plan. And if you look at the pockets they are targeting, are pockets where they can see good set of customers, industrial, commercial, and high-paying residential customers. So they are picking and choosing pockets which can be remunerative for them. And the parallel licensing, not the most ideal setup. So while giving options to the customer is what should be the direction, but parallel licensing is leading to a capex uplift. It could have been done in an alternate way where the existing infra could have been used by the same, by these new suppliers as well. But given the Electricity Act, the way it is right now, they have to set up a parallel network. which is going to drive up the capex in this space. I think the number for Torrent, which we don't cover, although, is 15,000 crores across the 3 regions over 5 years. And for Adani Energy, it's about 6,000 crores in the greater Mumbai area.
This is where you're just talking about current capex. So Adani 6,000 crores for greater Mumbai and about 15,000 crores for Torrent if it gets into these 3 geographies which it has outlined, right?
Yes.
Any sense on Tata Power if they go into this whole parallel network arena?
So their capex, we won't have a view yet. But again, there are different pockets that they are targeting, not these regions, other parts of Maharashtra.
Correct.
But again, subject to the area that they have to cover, they'll have to lay out the same, transformers, distribution transformers, conductors, cables across cities. So it should be a big capex number there as well.
So we'll just talk about how this is obviously great news for T&D players, and we'll Wayne get the view from transformers and rectifiers as well. But just before that, Nikhil, to complete the point for the companies themselves, is it going to be lucrative? I mean, at the end of the day, is it going to be a value proposition for shareholders for either Torrent or Tata if they decide to expand on the DISCOM network and go this way? And what's the sense? Can you give us some ballpark estimates? What is the value this will bring to the table?
See, it's still very early days, and this is not a common practice in India, a parallel licensee. These would be among the few ones. The only legacy one is in Mumbai that we have. So it remains to be seen how they evolve. But in terms of returns, if you think from a capex perspective, let's say a 15,000 crore capex would be about 30% equity funded, on which returns on a regulated basis could be about 15.5-16%. Once the network stabilizes, once you get the customers on board, once you reduce network losses, that's the kind of returns usually distribution companies can make.
And to get to that, return of 15-16%, what would you factor in terms of PPAs, power tariffs, costs, to ensure that there's at least that much ROI, at least on the equity component that's going into this funding of the capex?
Correct. Again, so very early, so they'll have to tie up new contracts for buying power from renewable companies, from thermal companies, which sort of for a new player, at least they won't have the old baggage, which less than MEC-DCL have. They have good contracts, bad contracts, which they have to live with. But the new parallel licensees, they can sign fresh contracts to buy power, and where they can optimize. They can buy from related group companies or from other generators, wherever they see the lowest levelized cost of power.
Okay, all right. Nikhil, request you to stay with us. So let's get in Mr. Rajora. Thanks a lot, gentlemen, for joining in. Well, Mr. Rajora, if you could tell us the parallel DISCOM services approved for players like, say, Tata Power, Torrent Power, what does it do to the overall addressable market for you? Any kind of approximate capex as well that you could look at because of this new addressable opportunity?
Thank you on this, first of all. Let me tell you that the broader prospect of this initiative is not only is going to be benefited for the companies like us, T&D Industries, but it is going to be the bigger service opportunity for the consumers also. And the state is also going to be benefited for this because the service and quality will going to be improved, as well as the cost of electricity is going to be reduced slightly because there will be competition in that. As far as the capex is concerned, as just now the other gentleman says that we do not know what is going to be the capex infusions are there. But yes, there is going to be a very, very sizable capex when you are going to create a parallel distribution network. And this is basically step is not going to be confined up to a city or a territory, but what I understand, the state government is more focused to reach out to the rural part of the states where the electricity is not reaching. And as says, is thousands of crores of capex is required into that. And probably as just says, the Torrent has come up with 15,000 crores, Adani is coming 66,000. Tata may end up more than this because traditionally Tata is in Maharashtra since long and they don't want to lose that areas, right? So this is going to be a bigger game changer, not only for the state, but is going to be for the other part of the country also. That is what I feel.
Got that point. Just hold on to that thought. The reason why the AkzoNobel stock is moving higher right now from lows, despite the deal being done at around 2,700 rupees itself, is because there has been an open offer which has been made, and the open offer made by JSW Group is at over 3,400 rupees, 3,417 rupees per share, if I read that correctly. And that explains why the stock has seen a big rally from the lows today itself, up 6%, actually the highest single day gain that we've seen all the way since the company announced that they are looking, the promoter entity announced that they are looking to sell this business itself. The open offer at 3,417 rupees is a lot higher than yesterday's close, and is a lot higher than the price at which the deal happened as well, at 2,700 rupees, which explains the big move that we're seeing. But back to the power discussion, on Torrent Power itself, the question is that while you are looking to grow here, can your existing infra, lead this growth, or you will have to put up some new infra for the same? Chanchal?
They definitely have to put up a new infra, because the existing infra will not be able to sustain this, and if they want to reach out to the every corner of the state or the city, they have to put up the new infra.
And how long before do you think this will actually fructify? Because, announcement is one, execution and the actual implementation of this is the other thing here. What are the realistic timelines?
This may take several years. This may take several years. It's not going to be happen overnight. In my view, it will take 5 to 7 years. Because first they have to go to the regulatory approvals, then they have to go for the different capex infrastructure things. They have to put up the setup, and ultimately to reach up to the last digital facilities. And then going to the metering and reaching to the consumers. I don't think it is going to be happened in overnight. I feel that it's going to be happened at least 5 to 7 years.
Gentlemen, all this is happening, and we're having this discussion at such an interesting time, because I want to remind our viewers, and this was actually a very recent story, so I don't know if people missed it. All of this is happening at a time when, for the first time in I don't know how many years, Maharashtra is looking at reducing electricity tariffs. In fact, if I go by the quotes that Mr. Fadnavis, and he has the electricity portfolio in the state, the quotes that he's given, that power tariff rates can drop by as much as 26% over the next 5 years. This is different from otherwise all the discoms coming in asking for a tariff hike in every year. Nikhil, comment on this. I don't know if you caught this news or not, but this is exactly what it is. And I'm quoting the minister. For the first time in Maharashtra's history, electricity tariffs are being reduced, not hiked, starting with a 10% cut in the first year. Tariffs will drop by 26% over the next 5 years in a phased manner. This is from Mr. Fadnavis. So, what do you make of this and all of this capex being put to work that we're discussing at a time when tariffs are going lower? Could that be an issue?
See, the tariff cut spoken about, firstly, it will be different for different segments of customers. So the lower end of customers possibly get a higher cut in tariffs, and industrial and higher usage customers, maybe not so much. The rationale for it, one reason we can foresee is if you look at the last couple of years, coal prices have come down. Spot market, which is exchange power prices, have come down. So from a discom standpoint, input power cost or input cost for them for buying power from different generators has sort of normalized over the last couple of years after the high we saw in FY23. At the same time, many discoms across the country took tariff hikes. So hence, a combination of this, higher tariffs, lower cost, is leading to a lower ACS ARR gap, or lower gap between cost of supplying power and revenue realized by many discoms in the country. So the number for your reference at the national level fell from 50 paisa to 19 paisa of losses per unit in FY24, and we think it could be similar or a lower number in FY25 as well. Given this factor, that's why.
Let's bring that back to Chanchal. Chanchal, you said everyone is looking to capitalize on this opportunity. The problem is the capacity and the availability of raw materials. Do you think that people will be able to, get that sort of raw material to be able to capitalize on this? Because demand, obviously, no problem. Everyone wants more power. But is there enough supply, enough capacity and availability of raw materials?
The thing is, raw material is a constraint as of now today. But see that these things are not going to happen overnight. These things are going to take place in almost, say, 5 to 7 years' time. And raw material availability is now slowly easing up. Yes, there are the constraint in some of the raw material aspects, like particularly if you see on the transformer sides, there is a constraint on the high voltage transformers, but distribution transformers are well available at this moment. But cabling is the constraint which is now easing up. Metering is available. The raw material things are easing up in this country, and this is going to be a 5 to 7 years chain. So I feel that we will be able to sustain and we'll be able to overcome out of this. That is what I feel into that. And look, reducing the electricity, which is just we were discussing about the electricity charges. We also need to understand that the cost of renewable energies is now going down, and lots of renewable energy is coming up into the country, particularly in states like Maharashtra, Gujarat, Rajasthan. And it requires the consumers, and it is this is giving a new opportunity to all the producers, and they're going to be benefited for that.
Absolutely. And I also just want to add here that this power reduction that's been announced in Maharashtra, it is being announced by the state discom, by Mahavitran. So that is where, I mean, that's the whole discussion, that what will be the viability. These are parallel networks. I mean, will they operate in the same geography, or whether the geographies will be absolutely clearly demarcated? So that's something that we have to see. Nikhil, finally, to round things up, what do you like here? The generators, distribution companies, you can play T&D, you can play the grid. What would you look at from an investment perspective?
No, specifically to this development on the distribution side, we don't have many companies in the coverage in the distribution space. Beneficiaries obviously would be the transformer manufacturers, conductor cable guys from this capex if it happens, and the three utilities which are applying for the license, Torrent, Tata, and Adani. But yeah, within our coverage, we don't have a direct play for this development.
All right, we take that point. Thanks a lot, gentlemen, for joining in and giving us your views on this. Let's see whether people can capitalize on this. All the initial issues are taken care of, and eventually everyone benefits. The customers due to higher power, and at the same time, investors who look at players who will benefit from that itself. But the big news of this morning has been the big deal in the paint space, where JSW Paints has gone ahead and acquired AkzoNobel. In fact, we had an inkling of that from many months. Why is that? Because Parth Jindal himself had told CNBC-TV18 at the World Economic Forum Summit in January in Davos about the AkzoNobel India acquisition, their interest in this business so far. Listen into what he had to say, and thereafter we'll get an expert to comment on it.
I think there's no choice. If JSW and the ambitions we've shown that we want to be a top 3 player in whichever sector we play in, if I have to do that, then I have to give it everything that I've got for Akzo.
How will you fund it?
It's going to be a mix of the family investing, and private equity.
All right, so that is, you heard it here on CNBC-TV18, Parth Jindal himself saying that because of the ambitions that they have in the paint space, they are targeting close to around 5,000 crore revenue by FY26. 2,000 crores is what they crossed in the previous financial year, just about broke even on the EBITDA. They have to grow faster, look at inorganic, and AkzoNobel was the asset on the block, and for which they had made an offer as well. The open offer for up to 1.14 crore shares of AkzoNobel at around 34.18 rupees per share. Gurmeet Chadha now joins in. He's the managing partner and CIO at Complete Circle. Gurmeet, you've been tracking the paint space for a while right now. Asian Paints obviously dented by the aggression shown by Birlas, but now we have major conglomerates who always had an interest in the paint space, but JSW going ahead and buying AkzoNobel gives them a higher chair at the table. What do you make of this for AkzoNobel and at the same time the paint industry in general?
Good morning, Nigel. It's going to get very competitive. We recently, and Jindal is an aggressive group. By this acquisition, it's already in top 3, top 4. We saw Birla Opus presentation, a few weeks back, where they spoke about annual capacity of 1,100 million liters per annum. That is just second only to Asian Paints, which is roughly around 1,900 to 2,000 million liters per annum. So, and Jindal will get aggressive. So, may not be great news for Asian Paints from a competitive intensity point of view. But overall, from a sector perspective, it shows you that the prospects are pretty bright. We have seen a series of real estate launches last couple of years. But the decorative side, the home improvement side hasn't done too well, whether it is paints and tiles and home decor and kitchenware, etc. And now as projects complete and the civil work gets done, the home improvement gets into shape. And a lot of the launches have been at the mid-affluent and high-affluent segment in NCR, in Mumbai, in Bangalore. And so the overall demand will pick up, but only from a paint industry point of view, there will be another, competitive pricing. Birla has already reached almost 6.7, 6.8% market share.
6.7, 6.8% market share. It's you suppose it is bad news for Asian Paints, but do you think it is bad news for the sector in general because margins of the sector would be compressed going forward, and at the same time there could be a multiple derating from here on?
See, it's already, some of it is already in the price. If you see the performance of the share over last couple of years, despite markets doing well, despite crude, being lower. In fact, this entire year, it's been averaging at around $70, $75. The stock hasn't done much. So some of it could be in the price. And maybe it may not reflect immediately. But yes, overall, from a near-term perspective, the industry does well, the volumes go up. But I agree with you, margins could come under pressure. Birla Opus also, when we did dealer check, they were putting up these machines, pretty quickly and at, almost at a very reduced cost. Asian Paints used to be very selective in terms of putting the machine, in terms of color mixing, etc. Birla became very aggressive there. So they obviously have been outspending it. And that also added to the pressure in terms of dealer footprints, etc. So I think it will create more competitive intensity. Good for consumers, may not be that great news for all paint players in general.
So the bottom line is, Gurmeet, I'm warning, will you start buying paint stocks? They have gone through such a long winter, but the heat is still on. Competition will probably come in. I mean, these are serious players. They mean business. The question is, buy paint stocks or still stay away?
I would suggest it would be not a great idea right now because wherever you see competitive intensity going up, we've seen that in cement. We saw that some of the price action in cables and wires also, but a lot of them have come back. So I think there are more opportunities in the home improvement space. You should look for things which are more predictable in a market like this. And market isn't cheap. It isn't that even, look at, for example, AkzoNobel shares. They haven't not done anything for the last 3 years, but they still trade at 30, 40 times. Asian Paints hasn't done much, let's say, last couple of years. But you're not getting it at 15, 20 multiple. So my suggestion is that Indian markets, the valuations are rich in a lot of large pockets of the market. So you have to be in pockets where valuations are more reasonable, pricing is more predictable, margins are more predictable. This is not a market where you just simply start playing momentum. And we've seen that in terms of price action over the last couple of months at least. So avoidable in my view. There are better spaces in home improvement. There is, as I said, nothing has happened in tiles. Nothing much has happened in sanitary. Nothing much has happened in kitchen and cookware and appliances. I think there are better opportunities there in my view.
Okay, got it. So play maybe the cooker and the tile and the bathroom fitting folks. Just leave out the paints for the time being. Got that point.
Just one clarification.
Thank you, Gurmeet.
Yeah, just one clarification on the entire paint industry. There are a lot of people when they keep talking about how new real estate supply will aid growth for the paint industry, etc. 80-85% of the paint industry still comes in from repainting as against the new supply. So even if real estate supply increases a fair bit, you don't have as much growth on the paint industry because it's 80-85% which is repayment demand. And even the prices of paints, everyone says, okay, prices of paints going down is good or bad, etc. for the industry. Prices of paints aren't as big a determinant of demand for paint anymore in the country because 30-40 years ago, you had 20% of the overall cost of painting that was labor. That has increased to about 50-55%. So if paint prices increase by about 10% or 15%, your overall cost of painting increases just by about 4 or 5% because 50-55% of the cost is still the labor.
Correct.
So that is something that we'll have to watch out for.
Absolutely.
Okay.
All right, with that, what we'll do is take a short break, come back on the other side. Amitabh Malhotra of HSBC India and Bhavesh Shah of Equirus join us, Wealth, to discuss the recent frenzy that we've seen in block deals.
Welcome back. Guess what? The dip is getting bought. Well, not too much. The market's flat, but that's the point, that every time there was a red, and there were 3 instances of red so far this morning, it's a different market, it's a different texture, and the approach is to buy the dip. And that's exactly what this morning has been all about, at least so far. Well, the other big headline from the market has been all the block trade activity and the block action. So that's exactly what we're going to focus on. We've seen deals worth almost 21,000 crores in the last 2 weeks alone. And of course, the number is much, much bigger if you start compiling from the start of the year. So to decode the environment, the drivers, the pricing, and all of that, we have with us 2 experts, Amitabh Malhotra, Vice Chairman Investment Banking at HSBC India, and Bhavesh Shah, Managing Director and Head of Investment Banking at Aquarius. Gentlemen, thank you very much for joining in. Amitabh and Bhavesh, good to have you on. I'm sure you folks have been very, very busy for the better part of the last 12 months because Deal Street has perhaps never been thriving as much, right? So let's get your opening thoughts in, Amitabh. The naysayers will always raise the question, is there too much supply coming? Does it indicate that valuations are near a top? But you tell us, which side of the argument are you on?
Look, I think the market is seeing and will continue to see a good amount of activity and support for issuances. There are a bunch of factors that have contributed towards these large set of issuance. As you said, there have been a lot of large blocks that have also happened. There have been recent scale down in geopolitical tension and easing of trade uncertainties. And there are other macro factors like strong GDP growth and recent rate cut that we saw. There have also been significant positive trends in the full year results by corporate India that has further aided the market backdrop. You've seen FIIs increase interest in the Indian market, particularly since April 2025. They were net sellers before that, but you've seen them become net positive buyers. Retail inflows and domestic mutual fund have supported this resurgence. So all of this have led to a reduced market volatility. It has reinforced investor confidence and enabled recovery in deal activity. So I'll summarize that recent IPOs at optimum valuation, strong moats, robust financial and well-funded growth plans offer really a long-term value creation that has received strong interest from local international investor, and we think it will continue to be like that.
Amitabh, just a question, maybe an unfair one, but I'm asking you from the top of your head. The exits have included both Indian promoters paring their stake and maybe raising money to invest elsewhere. But the exits have also included a lot of private equity finally moving out. And that's the nature of private equity, perhaps nothing wrong with that. But can you give us some numbers and some quantum, say in 2025 or maybe the last 12 months, whatever data you've looked at recently, what's been the total value of deals? And roughly speaking, how much would be foreign exits? And then the question, is that a concern?
Look, it's difficult to give you data at hand, but I'll give you some kind of indicators to that. You're right in saying that there have been a mix of both offer for sale and primary fundraise. And at the point being, the market has shown some really good appetite for secondary absorption with the likes of, for example, Hexaware Technologies. It was 100% OFS over $1 billion. And now we are seeing NSDL on the road with 100% OFS. So market is now accepting these stories. This indicates that the market investors have become more mature and resilient in accepting OFS as part of an IPO, as long as the company's fundamentals are strong and pricing is reasonable. And some of these examples that I gave are pretty much an proxy for that. Look, although fresh funding will still play a strong role in growth sectors like renewable, tech and fintech, we believe there will be a slight tilt towards OFS-led IPOs in 2026, particularly because the nature of these situations are where, like you said, private equity, some money to be taken by the promoter of the block to fund their other acquisition. You talked earlier about JSW Paints, obviously looking at acquiring AkzoNobel, so they've also funded that through that route. So we'll see that happening a lot more.
Okay. All right. Interesting thoughts there. Let me come to Bhavesh as well. Bhavesh, similar sort of questions to you. Your thoughts on the deal buzz that we've seen. And again, the fact that there are so many OFSs. I'm saying it's a sign of maturity of the market. Your thoughts? Is it a concern? Is it not indicative of maybe valuations?
Surabhi, thanks for having me on this on the show. What I can say is what we are witnessing right now is a completely game-changing scenario in the capital markets. It's a very, very positive sign that we're seeing in terms of both the absorption of the stock which is coming into the market, and B, the willingness of the sellers, or the ability for them to sell in the market as well. If you really look at the statistics on the demand side, it's 26,000 crores worth of systematic investment plan, mutual fund equity coming into the markets every month. And that's almost like a $3 billion. And the mutual fund investors, they are always looking for great companies to invest in. We have seen data where companies where mutual funds have invested, the same mutual funds want to invest more and more in them. For every IPO, that happens, there's a huge amount of work that happens by the mutual fund investors and other investors before they raise their hand to kind of invest in the IPO. But the allocations that they get in the IPO is far too little for the amount of work they do and the amount of resources that they have to invest. So it is this block deals which really help them scale up their investments into each of these companies. And we have seen that for every opportunity for them, they just kind of add, as long as the company is doing very well, as long as company has kept its promises of doing what they have done. I call that as a say-do ratio. If the company is doing what they say, they're maintaining a good say-do ratio. And if the say-do ratio for the company is good, the mutual fund investors are putting more and more money. And in fact, block deals are in fact a very good way for investing for the mutual fund, especially.
True.
Without creating any distortion in the prices. They can buy in bulk. They in fact can get a better deal or negotiated prices.
No, absolutely. And Bhavish, we hear that because when we quiz the mutual fund heads and the mutual fund CIOs, they say exactly that sometimes, you just don't have adequate stock in the market. So at least when there are good blocks, it allows us to participate. By the way, I think this consensus here within us in the studios, we love the concept of the say-do ratio. I think it should become a standard feature in all financial reporting. What is
not just financial reporting? I think everything ever, what you say versus what you do. What a wonderful ratio that is.
What about Mr. Donald Trump's say-do ratio then?
His will be the lowest.
That's a tangent.
Or rather the highest, depending on 2 weeks. Yeah, so his say is a lot more and do is, we don't know.
Shouldn't go there. Okay. I'm bringing the discussion back to investment banking. But Bhavish, you also raised an important point, right? That mutual funds have been, the whole fraternity has been such a strong support, right? They've been buying a lot of the paper that's on offer. But again, I'm playing devil's advocate here. The fact that mutual funds are not getting the kind of flows that they were getting at the peak of the market, and maybe that turns because the market's turning, sentiment is a big thing. But the last 4-5 months so far this year, flows have been coming down, systematically coming down month after month. Could that be a risk? Who will absorb all this supply? And is oversupply a risk for the market? This is something, and I'm not saying this, this is something that CLSA's Vikas Jain told us just earlier this week, that from an overall listed market perspective, the sheer supply of paper could become a concern. Let's take quick thoughts from both of you. Bhavish?
So I personally feel that, we used to have in investment banking something known as a overhang of stock in the market. And we would advise the stakeholders before they went public to see how they can make this as diverse as possible, their shareholding, and as long-term as possible so the incoming investors don't see this as a stock overhang and which can have a potential stock pressure. We are now seeing a complete reversal of that situation, in fact. And again, I go back to the same, if the company is performing well, in fact, the investors want to invest more and more in the same company. So in fact, the stock overhang is now becoming an opportunity for many of the investors to see that I just don't need to hold a small stake in the company. I can eventually hold a larger stake with the kind of money I'm getting through the systematic investment route. I can deploy more and more in the same company. So in fact, the stock overhang, as long as the company is doing what they promised to do, I don't think stock overhang is an issue at all.
Okay, very quickly, Amitabh, your thoughts? Is oversupply a risk?
It's a multi-billion-dollar question, but seeing it from our lens, I think with many companies getting ready and already lining up for public filings on the back of a fairly robust second half 2025, we believe the momentum will continue in looking forward on 2026 as well. And then you talked about both FIIs and in terms of mutual funds. The AUM for domestic asset managers is growing on a monthly basis. And we think they command now a significant space and weightage in participating in many of these issuances. So the point being that with FIIs becoming net buyers and DFIs continuing to kind of increase in their AUM, we think there's going to be significant activity also in the secondary market. And but and there's always a but. This outlook remains subject to overall market condition, regulatory developments, and evolving geopolitical landscapes, because that could influence timing and investor sentiments and create short windows of opportunities. So I will say optimism with a bit of caution.
All right, gentlemen, appreciate you joining in and filling us in with your take. We look forward to revisit this particular point in the couple of weeks or so. Thanks a lot for joining in. Getting back to the markets, though, the Nifty, well, it's more or less flattish. The Nifty Bank is down close to under 100 points. The trend is still up, as we've been mentioning. The 20 DMA has been crossed decisively, but a few stocks doing a thing of their own. Case in point being Dixon Technologies, that is up close to around 4%. Mitesh Thakkar is back with us. Mitesh, what's your take with regard to the markets? We started off well in the green, pull back a little bit. Would you use a dip to buy into the Nifty and Nifty Bank?
I think on the index, maybe not, but I think it's, the index has been moving so slowly, barring the past 2 days, that the trading interest may be slightly on the lower side, though the drift is still on the positive. So I'm positive. I think the index would go to possibly 25,700. But entering now after 2 days kind of a rally may not be the best idea. So avoid the index, but trade with long bias on the stock side. I have a buy on Coal India with a stop at about 392 for targets of 410. And Coforge has given a good breakout today, good continuation signal. So buy here with a stop at 1920 for targets of 2025.
All right, we take that point. Mitesh, thank you so much for that. We'll take a short break. On the other side, Manisha Gupta joins in with all the updates from the commodity space. Stay with us.
Welcome back. Well, let's shift focus to the commodity markets now. We have Manisha joining in. Manisha, it's a happy Friday for equities. You tell us what's up with commodities, considering the dollar is falling so dramatically. What does that imply?
Oh, absolutely. I'm looking at the copper prices, because metals, when you look at the month of June, clearly have been outperforming. So while the crude prices are consolidating and gold really hasn't done so much, but it really is metals, and within that as well, it is copper that you have to keep a look on, because we've seen overnight gains in copper to the tune of 2.5%. For this week now, we are at 5.5% for copper. And for the month of June, as I said, we're looking at 9% of gains coming in for copper, and clearly outperforming 2025 for many of those base metals there, with nearly 28% of gains. So copper, clearly the next gold, is what the street seems to be talking about. That phrase has been coined, and we've seen copper kind of live up to that. Well, Iran-Israel ceasefire is one of the factors that has led to some support coming back in case of industrial commodities. And then the markets also are looking at the weakness in US dollar index, which is trading at a 3-year lows. That has been supportive. Take a look at the demand-supply numbers as well, and that has been supportive. When you look at the spot prices, they are trading at a $300 premium to the 3-month futures. So that tells you that the demand in the very near term is on the stronger side, and we have seen backwardations go all the way up to 2026 June. So that tells you that there is supply concerns absolutely coming in. The ready available inventories have declined by 80% in 2025 till time. Well, actually, it has been a 60% of a decline from the month of March itself when it comes to inventories. And with the kind of inventories that LME is holding at this point in time is perhaps just good for 1 day of global demand. So there are concerns coming in because of that one. Also, when you look at supply disruption, well, we've seen that also continue into the trade there. There are risks on tariff. You could be looking at tariffs coming in copper. US has been talking about it for some time. And then refined copper shipments to US are at multi-decade highs of around 2 lakh tons. So everywhere that you look, you're looking at very strong copper fundamentals there. I also want to take you through supply disruption concerns coming in from Chile and Congo as well. Whether it has been about refined copper, supplemented copper, or mining itself, there have been some disruptions coming in. If you look at the consumption in the meanwhile, and that comes in from IEA's data, which tells you that in 2023, while we did see 26.5 million tons of copper demand, by the time it's 2035, the copper global consumption is expected to gain up by almost 32.6 million tons. Much higher, and well, no, we're not looking at supplies increasing in the same way. The consumption for the clean tech is expected to gain much higher. 6.4 million tons in 2023 is expected to be at 11.5 million tons by the time you're in 2035. Well, this demand comes in from EVs, from chips, from transportation, from construction, and of course, energy transition. There's an important statement coming in from BHP as well, which say that the copper mine grade is constantly declining. They also say that where we were at least a couple of decades ago, the grades have continued to decline. The mines also are facing aging challenges. So on the mine side as well, there are concerns coming in. And more interestingly, the University of Southern California says that next 20 years, the kind of copper demand that you would be looking at is the kind of demand that you have seen until now in all of these years. So with those kind of numbers coming in and everybody putting in a very, very bullish tone for copper, the prices have only one way to go, and that's higher.
Okay. Got it, Manisha. Thank you very much for that. Well, with that, we have to take a very quick break. Come back on the other side, and it's our special segment, Indianomics. Lata speaks with economist Praveen Krishna of Johns Hopkins on the likelihood of reciprocal tariffs after the July 9 deadline.